Hello and welcome to Trading Growth and Value Stocks. My name is James Boyd. We welcome you here today on this Wednesday, October 22nd. Just real quick, we also want to make mention, we have Ben Watson in the chat. He is teaching the Advanced Options online event in the evenings. So make sure you know about that. Many of you probably did, but I just want to make sure he is teaching that. Ben, if you could share that link where they could actually see that as well. We also got Bill with us. Hello, Kevin, Thea, PR451, Kelly, and many others. Welcome and good morning. Now, just real quick, we're going to talk about kind of some of the weakness we actually saw overnight in the Netflix earnings. We'll talk about that. We'll talk about actually some places where we could be seeing some rotation. We talk about gold and silver maybe getting pushed down. Is that capital being pushed to somewhere else? We'll talk about that. And also, I want to kind of bring up the point that sometimes as you go into earnings, some investors might just choose to buy the sectors or the industry groups over the stock. And I want to kind of just throw that out here right off the bat. Now, and we'll talk about why as we look at these charts in just a moment. Now, as we get started, remember the information here is provided for general informational purposes only. When we talk about examples, we will use the Paper Money software application for educational purposes. Also understand that when we talk about investing involves risk, including loss of principal. And also remember when we talk about our examples here today, we'll talk about whether they're growth examples, value examples, or income style examples. And then what we're going to do is we're going to look to try to actually expose or try to find what are investors really buying and where could those trends be. First off, let's take a quick look at where the Netflix is. Now, this kind of leaving a little mark here on the NASDAQ itself. Netflix going down about 9.5% in the after hours and then getting into this morning. Now, what you're now going to notice is if you look at that, it wasn't just down, okay? It was down and taking out the prior low. That is a fresh low on Netflix. Now, did it really affect the consumer discretionary space? Let's take a quick peek. If we pull that up just real quick is it didn't really do anything, okay? So the first thing I want to kind of point out here is, buying or selling stocks or over the earnings, risky. It's stock could go to zero, okay? Stock could go up to infinity. You don't know. You flat out don't know. Nobody knows what's going to happen. We don't know who's going to be selling on the other side of that earnings and how those earnings will be received. You take a look at the sector, okay, didn't even move, barely. Down 0.5% on this IXY sector. You might use a different ticker, but it's not ETF Friday, so I can't pull that up. Now, the one thing I want to kind of make mention is when you look at, let's say, the Dow itself, and the thing that we've been kind of talking about is could the market be setting up maybe a consolidation after some of the big run it's actually had? So far, it's kind of what's been happening. Now, the Dow yesterday did go to an intraday high, okay? Today, down 83 points or less than 0.2%. Now, that doesn't necessarily mean that all of our positions are acting like the Dow, but that's we're talking about the Dow. When we actually take a look at the SPX, same point movement, same percentage movement, but you're now going to notice is we're kind of, I drew the lines for the channel. And if you take a look at the channel, we're kind of near the top of the channel, trying to hammer back after this morning's weakness that was maybe caused by actually Netflix. Now, if you actually take a look at, let's say, the S&P, there's a lot of, I would actually say there's decent breadth in the market if we're talking about more sectors becoming involved. And we'll show that in just a second. When we look at the NASDAQ, which is the hardest hit, if you look at, let's say, the NASDAQ, that looks just like the S&P 500. Now, again, all of our stocks are not like the indexes, so that's kind of important to note there. But the indexes, the reason why we talk about the indexes is if the indexes go up, it's probably a good chance that the stocks could go up in general, okay? Now, obviously, the thing we do want to point out is when you look at the stocks, so speaking of something that's maybe not acting like the index per se, stocks is a little weaker here today. But then if you go back to yours truly, the gold, well, when that ball starts rolling downhill, okay, and sellers start selling, people don't want to be the last one to sell. And so there's been a little accumulation in momentum to the downside for gold. Now, why does that matter? Now, remember we kind of been saying that maybe as staples were weak, healthcare was weak, utilities were weak, real estate was weak. Maybe the precious metals had actually become, okay, in this case, a way to kind of trade, let's say, something more low beta, if you will. Well, if you take a look at this, historically, gold has actually been going up, okay? And I'm going to put over here on the right-hand side, U for utilities, R for staples, okay? I'm going to put RE for real estate, and I'm going to put V for healthcare. Now, so in this case, gold had actually been going up, and these had actually been going down for the most part. Strongest move we actually had in there was utilities. Now let's flip this around. What actually happens if, forget that we're actually going up, let's say that we're now going down on the gold, could we actually have, in this case, that utilities, staples, real estate, and healthcare could be going up? Oh, just out of the corner of our eye, we're actually seeing healthcare. We'll look at that chart in just a sec. There's staples right there. There's real estate right there. The only one that was weakest but had been the strongest is utilities. So it kind of looks like they're playing the inverse of the position now. As gold actually sells off, where's the money moving to? And it looks like it's moving right back into staples, right back into real estate, right back into actually healthcare. Which one is the strongest? Well, if you pull it up, I don't think it's going to take very long to kind of tell you that it's blasted healthcare. So the reason why you want investing education, it doesn't have to be that all the time you have to invest in stocks and stocks and stocks and stocks and stock. No one said that, okay? It's our limitation in our own mind. First off, the investor might say, first point I want to make is precious metals, okay? Shifting, I should say weakening, okay? Weakening. And is this pushing back into staples, healthcare, real estate? Okay, so that's the first point. Second point I really want to make here is it maybe, do investors consider, question mark, buying the group, and what I'm saying right there is the sector, choose buying the neighborhood. Okay, so point number one, we actually talked about the precious metals weakening, pushing back into the lower beta areas. Number two, just repeating because the internet kind of bogged. Second is if we talk about, let's say, buying the individual names versus, let's say, just buying the area, that's point number two. Now, we are not saying that, oh man, if I looked at IXV, there's not any individual names in there that are getting a push. Obviously, we could just pull those up and just go to just real quick market watch, visualize, and just say, if we were to look at healthcare, now you could literally look at this, okay, healthcare there, but you could also just say, look, could you zoom it in for me a little bit? Go to healthcare, and this is going to give us a list, and we can see immediately which ones are really getting the push, okay? Now, obviously, ISRG, Psych, BSX, this does not tell you that they're upward trending. This just tells you the performance for the day, okay? Now, the other thing I want to kind of point out here is the staples. Now, if you look at the staples, and this kind of goes back to, if we look at this, we broke down, right? We actually had a channel on the staples itself. And what do you see on the staples itself? And I'm going to kind of point out here ones that are a little stronger. If we kind of had to say ones that are stronger, relative strength so far, we're going to say healthcare, okay? And the second one we're actually going to probably say is staples, okay? Now, if we actually pull this up, one, okay, staples, you get healthcare, which is more of a flag setup. Staples is more of like is more of a reversal channel setup. Reversal meaning that it broke down through support, rallied back up to resistance, which should hold technically, but might not. And all of a sudden, those investors who sold, they're trying to get back in. Okay. Now, could they be buying the group? I think we've said that. Okay. Could they be buying an individual stock? They could. Okay. Now, the third one, well, what about the utilities? Just quickly. Utilities, remember, if we're on the south side below the moving averages, that's probably not the setup that technicians are looking for if they are looking to buy. They're usually looking for things above the moving average. So there's kind of a little rain. I call it, if the price is raining down, there's currently more sellers than buyers in utilities. Now, if we go to the one area that we have not made mention of, what about, let's say, real estate? Now, remember, we've been in a backdrop where the interest rates have been slowly going down. I'm going to kind of point out here that, let's say, IXRE, okay, real estate. Now, real estate could be broken down into many things. We're talking about commercial property, personal property, homes, apartments, healthcare, shopping malls, you name it. What type of real estate? What are we talking about here? Okay. But I would probably, if we're talking about kind of putting them in pockets of where the relative strength is, IXRE next. I want to just kind of look and see if we're missing any. The one other thing we're kind of make mention of is also the transports. Okay. Now, I'm just going to kind of point out here the transports. When we actually look at, let's say, now, why do we bring that up? We saw crude hit, 56 the other day? Okay. When you look at these other areas, like are we saying technology is weak? Oh, we can't say that. Okay. If you look at this, say the communications, kind of looks like it's still holding in there. If you look at, let's say, the IXI, the industrials, that was almost at the brand new high yesterday. Okay. And if we look at, let's say, what does the energy look like? The energy is kind of in that consolidation again. So kind of when you look at the market in general, not that bad, but it is more choppy. Now this goes back to strategy selection. Okay. If you think the market is going to be more choppy, you might dollar cost average the shares. That's an important point, meaning you're not buying the whole position at once. Why? Because you think the price might chop in a range. By splitting up where you get in, you're trying to actually dollar cost average down, hopefully, to where you actually can get closer to the support. Second, if you actually trade derivatives, you might say, I'm just going to do a strategy where the sensitivity to direction is just not as high. Okay. So I think those are kind of some of the major takeaways so far. Now, the comment is, hey, I did a trade where there was a cap gain in place, ISRG gap to the upside. Yeah, look, you invest long enough, those type of things happen. You could have also said you had Netflix and a gap to the downside. Don't be too hard on yourself. If you're in a situation where there's a maximum gain, I think a lot of people just say you should be thankful for at least it was a maximum gain, not a maximum loss. Now, let's kind of go back to something just real quick. So I want to kind of pull up some stocks that might be showing a little strength. Now, when we take a look at these, we're going to look, now this class is called trading growth and value. We're going to look at kind of the technicals of it, but also the fundamentals as well. And for me, I always like to kind of start looking at the Dow first. Large mega cap names with high stock volume, and also lots of institutional interest, but also maybe something that might actually have volume in other type of investment. I'm going to pull up just real quick IBM for just a second. Now, if we take a look at IBM, speaking of something that has earnings, the earnings is after today. Now, this is exactly what I'm talking about. You could say, James, today I'm seeing a setup on IBM, and I'm thinking that might be bullish. Sure. Okay. But the thing is, we don't know, do other investors, are they going to play in the hold after the earnings? We don't know. Okay. I don't know what their intentions are. Okay. Now, if I went to, let's say, just real quick, Google, does Google have earnings that close, like literally today? No, Google actually has earnings next week. So it's not a whole lot better, but it's at least not this afternoon. Now, if I were to ask you a question, do you see an uptrend here on Google? Now, if we were to kind of look at this, one of the patterns that just kind of like blows my mind a little bit, when you see a prior high and you see it drop down and then it runs back up to that prior high and just a little bit of a pullback. Now, I know you wish you could see the future. Me too. But the whole idea is if you actually had, before you actually had this prior high, I'll label as PH, little pullback, some people call it the cup, little right-hand side, little fleek, and a little push to the upside. Now, before this, what was happening? Well, what before it was happening is you actually saw a long pull. Okay, got to get air back. Well, this is the whole idea of continuation, right? This recent move, and how far could you go back? I just went back just recently. We did not pull back that much. And if you look down here on the bottom, okay, the MACD is actually getting shallower when the price was really making lower lows, okay? Now, interesting, kind of like a bullish MACD divergence. Do we know that it's going to break to the upside? Lisa knows. She always knows. Now, if we take a look at this, let's kind of do an example on this where the investor is expecting the price to break out. Now, here's the deal. It doesn't matter if the market's going straight up. It doesn't matter if the market is going sideways or down. The reality on any given trade, you're taking risk. That's what you're doing. I'm going to right click on this chart. We're going to go to buy custom and we're going to go with OCO bracket. Before I do that for just a second, the paper money account, let's go back to analyze for just a second. Now, Google for a while had really kind of been doing nothing. I mean, it was just kind of going down, down, down. But you go back here, this might have been one of the most quietest moves from 140 to 255. I don't see a lot of people talking about Google for some reason. But there's kind of something different that is actually going on here. When you look at this on a weekly chart, this is not your typical Google run here. What is going on? Now, this green shading had been green, it seems like, for a long time. We had a crossover to the downside, which we've just been going through. Could we be at the start? Oh, that'd be nice. Of maybe this new cross back to the upside on the weekly chart. Time will tell. Now, what I'm going to do is when we go also to the analyze and we pull this up and kind of take a look at where they are, these numbers. Now, the numbers on the columns, okay, 24, 22, 21, 20, the numbers in 24, that was substantially different than where they had been historically. When you take a look at also the sales per share, think of revenue divided by the shares outstanding, that is twice as much as it had really been before. When you take a look at return on equity, you're talking about net income over average equity. You know, you're talking about 32 compared to 18. You're talking about return on assets. You're talking about sales over average assets. You're talking about double there, okay? Now, what you're going to notice is these gross profit margins, they were holding steady, and you're looking to see if, even if the gross profit margins, gross profit divided by sales, if they can get these numbers, if they can become more profitable, even with holding the gross profit the same. And they were becoming more profitable. Now, how do you do that? You cut overhead, people. You actually just become more efficient in general, okay? Maybe cut some buildings, things like that, cut costs to squeeze out more profits or revise contracts at a cheaper rate, selling the same amount of stuff, all stuff that we could probably think of ourselves. Now, if you take a look at this, what you're now going to notice is long-term debt to capital. You're actually seeing that number is shrinking. Is that a bad sign? I think many investors would probably say, you know, that would actually be good. Could actually mean less interest expense and higher potential net income, okay? Now, if we go back to, let's say, Google for just a sec, let's bring up the paper money account. And what we're going to do in this case, we're going to pull up just real quick there, and we're going to type in this. And what we're going to do is right-click, buy custom, let's go with OCO bracket. Now, if we did with OCO bracket, what are we really saying? We're going to try to get in, and we're going to set a target. So let me just set this up like we were seeing before, and I'm going to kind of redraw this. Why? Because I need to know where the target is. Now, if we were trying to kind of set a target, the first target would be what? The first target would be what? Well, the first target would be where's the bottom of the channel, where's the top of the channel, and then adding the width to the resistance line. So if we actually look at this and said support to resistance, how far? It's about $14. Add $14 to right there, okay? 269.20. So that's going to really become our first targeted area. If we said what's most probable, if there ever was such a thing, probably right about 269. Now, if we said, well, James, could I drop Fibonacci and kind of do that as well? Could maybe our target coincide with that? Well, yeah, we could go back to where the old high was. Where's the old high? We draw from body down to the lowest body. And what you're now going to notice is the 161 is going to be at 265. The 200 is at 272. Now, if you're not using Fibonacci, you need to, because they actually do a nice job as far as actually tracking momentum. And it also, for example, at the same time, actually is just, it's math, okay? Now, what I'm going to do in this case is I'm going to put a target right at 269, okay? Now, if I take a look at this, if I set a target, let's say 269 limit day to GTC, okay? If I do that, now I'm on this right here, and I'm just checking the stream. Just let me know. I got 269, and then what I'm going to do in this case is I'm going to set a stop underneath where? Well, if I went back to Google, just real quick on that chart, where's been an area of support? Well, on Google itself, the moving average has really been acting like a support area, especially since yesterday. It closed above it. Now, what I'm going to do is I'm going to take, let's say, I'm going to take yesterday's closing price sitting right on that moving average. I'm going to set that stop right below there. Thanks, Ben, for commenting on that order. I'm going to take about 250 and a quarter less 0.98. And what we're going to do is we're going to set the stop at 245.23. Okay. Now, if you said, James, this is around earnings and I don't like to take full positions around earnings, fine. That's why we can actually kind of have a range of how much the investor is willing to invest. 245.23. Okay, so 245.23. Now, if I come back, now let's say normally, okay, let's say we normally buy 10% of the portfolio value, but I only want to do 5%. Well, if I only did 5%, it would be 5% of about 38,000. 5% of about 38,000. If I did that, if I was going to go that route, 5%, it's going to be about 38,000 times, there you go, 1,900. Now, it doesn't really matter the amount. It just matters the discipline to stick to the range. If we said in any given time, we're going to invest up to 10%, to 10%. Well, here I'm only doing 5%. 5% would be 1,900. 10% would be 3,800. Half of that would be 1,900. And so it's going to give us about 7 shares. So if I just push it down to, say, 7 shares, there it is. Now, I know what you're thinking. I wish I could buy 100. I wish I could do that. You know, hey, that's nice. But not every position we're going to be able to buy 100, okay? At least not right this second. We're going to go confirm and send. And now what we're going to do in this case is we're going to send the order. So we got a target. Remember how the stop works. First of all, the target and the stop don't matter until we're actually filled on the shares. Second, if the shares fill at the price, that price or lower, then the stop is valid. And now what you're going to see is that's a trigger to sell, and it could fill at a lower price. Why? Because it's a stop order. Why? Because it's a market order. Okay? It's a trigger to sell. Now, our order is at 254.43. The stock right now is at 253.22. Could we get filled at a lower price? Remember, that limit is exactly what it sounds like. It's the limit of what the investor is willing to buy. And yes, it could be filled at a lower price. Now, Dan actually says, was there a paper trade on IBM this morning? No, there wasn't. Now, if we looked at, let's say, IBM, now I'll show this, okay? So the question was from Dean, have we done a paper trade on IBM? The answer is no. Let's say, for example, have you guys ever had the temptation to do a trade before the earnings? Have you ever had that temptation? You just wanted to kind of know, and don't tell me I'm the only one, okay? So the situation is you got earnings this afternoon, and you're speculating what those earnings could be like. And you're hoping that not only is it good, maybe they raise the guidance on their estimates going forward, and the market receives it well by not selling the stock off, meaning they hold their position and maybe even buy more, okay, and pick the price up. Now, let's say, for example, let's go back to this for just a sec. Let's say we said, hey, look, we're going to put up to 10%. 10%, 3,800. But wonder if we only did a quarter. Well, if we came into this and said, look, a quarter, if I went to, let's say, 38,000 times, this is 0.01, be 1%, okay? 0.0025, a quarter of that. Now, if we did this, what it's going to really do is if I take, well, let me take it like this. If we said, let's say, 38,000 is the balance, then we actually said, for example, up to 10%. That's a 3,800. But let's say I only want to, for example, I just want to do 2.5%, 0.025. Now we said if we did 10% of 38,000, it'd be 3,800, 1,900 if it's half 5%, 2.5% of 38,000. It's going to really be a budget here. If we looked at that, it's going to be about $950. Now, that's only going to allow us to get 3 or 4 shares over earnings. Now, I'm going to tell you, just because it's only 3 or 4 shares over earnings doesn't mean it can't go up a couple $100 up, a couple $100 down. We've seen so many examples. Now, in our paper trade, what we're going to do is we're just going to do 5 shares. Now, you might say, well, this is foolish. We've seen multiple examples where there was only 4, 5, 6, 7 shares, and there was almost sometimes up or down, $1,000 up, $1,000 down. So don't think that all 5 shares, it's not nothing, okay? It depends upon the movement. And you also got to remember, as a bigger dollar stock, you know, if it moves $10, $20, and so on, up or down, it moves the profit loss up or down. Now, what we're going to do in this case is we're going to buy 5 shares. And what I'm going to do in this case is I'm not going to set a target, okay? What I'm going to do in this case is I'm just going to put 5 shares there, stop underneath. What we're going to do is we're going to look back and say where. Now, the reason why I'm bringing this up is a lot of people say, I don't want to risk a whole lot, so I'm going to set a tight stop. You've just fallen for the trap. The trap is that you don't understand that the volatility is probably going to be wider than normal. So if you set tight stops, you have a really high chance of getting stopped out. You did it to yourself. Well, we're not going to do that. We're going to set the stop underneath that 20-period moving average, which is now green, and we're going to set it right at 278.89. So I'm going to go back to this and put it at 278.89. Okay, less. And now what you see is we're going to put it at 273.31. Now, we already looked at the Google fundamentals. If we go back to the analyze and we go back to, let's say, fundamentals here for just a second to kind of see the run that it's been on, or has it been, the run here is not as big as Google. But if you kind of look at this in the last couple of years, it is higher over the last couple of years outside 23. The numbers actually here on the top line are in the highest kind of percentile over the last 5 years. About 10% higher, not massively higher. We're not talking about NVIDIA numbers here. But if you also look at these numbers of the ROE, okay, pretty solid on the ROE. But now what you're going to see is there's differences between margin percentages. Some companies like Microsoft, as we'll look at here in just a sec, they have different percentages. And look at, like, example given. Look at, let's say, IBM to Microsoft. Look at Amazon compared to Walmart. It's amazing when you look at the differences. Now, if you look at these numbers, they've kind of held. They're a little bit less on the net profit margin, and there could be some reasons for that, okay? You'd like to see that number at least hold at the minimum to even get better, meaning they're actually being more efficient. Now, I want to go back to just real quick, speaking of Microsoft. So second trade example, IBM, we know it's on the doorstep of earnings. We took just a quarter of a position, okay? And now what we're going to go ahead and do is confirm and send. Now, I'm glad you so Dean brought up the example. So yesterday we brought up a stock. I'll just kind of point this out just real quick. We talked about the example of could Meta be breaking up through resistance. Saw that this morning, that the stock kind of poked its nose above that level of about 735. We're not holding there yet, but that's actually one kind of, if we're talking about maybe a snap back type of trade. Meta is probably on the short list by many technicians to see, can it do that? Okay. Now, let's go back to kind of the one I wanted to go to, which is Microsoft. Now, a couple of days ago, we showed the example of selling Microsoft. Why? Because there was a sell signal. That's why. Okay. Now, just because there was a sell signal per the rule set that we talked about, doesn't mean that the investor can never get back in. Now, I want to ask you a question here. How many of you struggle with once you sell out, that you struggle with seeing the reentry of getting back in? How many of you have ever struggled with that? Any of you? Like if you said, James, I sold here on the right-hand side, but I don't know when to get back in. Well, it goes back to kind of the same entry that we actually had before. So if we follow this day by day, and if you told me ahead of time, James, my entry is number 2. What does that mean? That either means the 20-period moving average goes green, kind of showing more confirmation, or that the crossover happens. All right, so you tell me where that is. Now, what I've actually seen in back testing, this is over years, a lot of times when you get stopped out or when you sell out manually, the reentries on a high majority basis will come inside, and the numbers that I've seen, they're like 4 to 10 days. A high percentage of the time, you'll see a buy signal within a week or two of when the investor was stopped out or sold out. Now that really kind of begs the question, well, why not just hold on? Well, because we don't know if they're really going to come back, okay? And the investor is maybe trying to lock in some unrealized profits to realize those, or just try to protect capital, okay? The point to actually understand is, geez, if I'm manually selling out or I'm getting stopped out, I probably want to have that on a list to be watching. Exactly. Now, what I'm going to do is we're going to go forward here. Now, we already know what the signal is. We're not getting in until we get entry signal number 2. We already know that. It's not, well, what are we going to do today? Don't see anything. Don't see anything. Don't see anything. Don't see anything. You see what happens? Day by day by day. Oh, now, what do we see on the right-hand side? Well, what we see on the right-hand side is we see a little push. Now, if you're waiting for number 2 setup, is that the start of it? Darn right it is, okay? Because before I get number 2, I need number 1. Is that setup number 1? The answer is yes. So if I was watching that at night and I said, geez, what am I going to be watching tomorrow? Probably going to be watching is Microsoft getting that little step number 2. Now go forward to the very next day. What do we got? Is that a crossover yet? I can't say that. Now, is that a bad sign that, for example, the stock is above the 20-period moving average? Of course not. The stock is above the 20-period moving average. What's the likelihood of the moving average going green? High. What's the likelihood of crossover? High. Okay? So you kind of had 2 days heads up. Pay attention. 2 days heads up. Moving average actually goes green on the 10-period. Day 1. Stock actually goes above the 20-period moving average. Day 2. Don't say, I mean, this is almost half the week. Okay? We can't say this was just overnight. but we can kind of start to see that slow turn that's happening on the chart. Now, what happens on the chart? Doink. All of a sudden on the 21st, which was yesterday, now the stock is really showing a little crossover. That's where we can see that little push. Now, we saw the stock gap to the upside, sell off down near the moving average. Why did that intraday low go right down near the cross of the moving average and go back to the upside? What was that? Was it, you think that was a little random, or was someone watching thinking that those moving average lines could really be where, hey, could it be new support? Somebody thought so. That's why they bought. Now, if we go forward to today, so if we said, look, the investor's buying on 2, that was 2. 20-pair moving average goes green, and there was a cross. Now, you could say, well, James, I could actually give it 2, but I can't say 3 because I didn't see the crossover. I didn't see the separation of the lines. Well, now we do. Okay, now we do. Okay, now here's the deal. If we take a look at this, okay, now what you got to understand is if we are in choppier market conditions, okay, if we are in choppier market conditions, the expectation is that there's just going to be there can be some winners and some losers. There's probably going to be more of a split. Why? Because the market or many stocks are consolidating. Stocks are mimicking what they're probably seeing on the indexes. That's why, trading in more sideways markets is a little bit more technical, because you don't have the high win rate that you actually did, for example, as when the market was just going straight up. Now, I know it would be nice if the market just went straight up all the time, but it doesn't always happen, okay? So you got to understand that if the market goes sideways, being very technical where you're picking the entries is a big deal. And also having kind of an expectation that some of these stocks might not just trend forever. They might trade in that 6, 8, 10% range from low to high, from support to resistance and so on. Now, they got earnings coming up. When is the earnings? It's going to be on the 29th. We go back to the fundamentals for just a sec. And by the way, let's bring this up. We're going to right click on this chart. Buy custom. We will go with OCO bracket. Okay. So what's up? What can cause some frustration sometimes is, hey, the stock was up. I was expecting it to uptrend even more, but then it pulled back and I gave it all back, right? If the market, which the market currently is in a consolidation, you might say, look, if I get 6, 8 to 10% above and beyond what the investor paid for the shares, that might be a realistic target. Because thinking that the stock is just going to go up and depart away from what the index or the sector is doing, it becomes less probable, okay? In other words, we're putting our expectations of what we wanted to do versus probably reality, okay? Now, what I'm going to do is I'm going to go buy custom with OCO bracket, okay? What I'm going to do is I'm going to back this off and kind of say, okay, was there any resistance above this chart? Okay. Now the comment is, what's the meaning of the checks of the on the watch list? Well, so one thing maybe you don't know is, let me kind of do this on the S&P. If on a daily basis, which wouldn't be a bad idea, I'm going through the list like Costco, and I said, man, Costco kind of looks interesting here. Well, when you press down on your keyboard, okay, just go down. What it's actually doing is you're just going through the list. Going through the list. I'm not touching, the only thing I'm touching is the down arrow. Please, okay, do not click, okay? Just press down, 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 down. This is how we're rifling through the watch list. And if you said, hey, I'm kind of interested in that example, well, just do control spacebar, okay? So if I go back up to IBM, hey, that kind of looks like an interesting setup too, control spacebar. Well, Microsoft. Okay, now if you're saying, James, this chart is just too far back, it's hard to see it. Well, go back to time frame, let's say 6 months, okay, daily. That way it's kind of zoomed in a little bit more. And if I said, hey, I want to actually kind of watch that, control spacebar. And when I do control spacebar, it puts a check. If I go back down to Microsoft and go control spacebar again, it just takes off the check. The checks are kind of stocks or indexes or sectors that you're watching. And then, so when I'm pulling up a list, I don't have to remind myself, oh yeah, I'm kind of interested potentially in Pepsi. There's already a check mark there. That means I already kind of spotted it, and it's something I want to be watching throughout the day, the week, etc. Control spacebar to put it on, to put the check on, control spacebar to take it off. If you're on a superior machine, Mac, you might actually say, look, I'm going to use command spacebar. I'm just joking. I'm kind of not. Okay, so hard not to tell the truth. Now, those PC software updates just really get you. Okay, now, what I'm going to do is let's go back to this just real quick. So when we look at, let's say, Microsoft, let's go back to this. If we were to set a target, okay, and by the way, last thing to kind of point out on this, you want to kind of move this over. The whole key to kind of clicking down or up is just making sure that you put that chain right there. I'm talking about this. Make sure it's set to 1. When this chain is right here, okay, you're linking, hence a chain, to number 1. Okay. So now when I click on it right there, it's synced up. That's what that's really doing. You're linking, okay, the watch list to the chart. This is why people don't do the discipline of going through the Dow, S&P 100, NASDAQ, because they're clicking and clicking and clicking. It should only take you 15 minutes to go through the 3 lists of Dow, NASDAQ 100, and S&P 100. It should only take you 15 minutes. When you do it every day, and you start using those tools like down arrow, control, okay, that looks no thank you. That one looks interesting. The investor goes, well, what about Simon Property Group? Well, look on the right-hand side. Does that look like something that might be of interest? Control spacebar, okay? So all of a sudden, we're just kind of using the keyboard, and all of a sudden, we're just kind of thinking, what else looks interesting? Oh, Bib's getting a little crossover, control spacebar. Lowe's, what about Lowe's? All of a sudden, we're like, hey, green shading on the moving average. We got to, what I did is I zoomed in on the chart for 6 months. Could we take it down a little bit more so we could see it closing? Sure, okay. Now, if you take a look at, that's absolutely right. Kelly is absolutely right. It's easy when the setup is right. Boy, we would like to close today's session with that in mind. Yeah, there's nothing worse than just a poor setup, okay? It just makes it so hard, okay? And so now if we said, well, what about ExxonMobil, okay? So you're just kind of using efficiently those tools, and it allows you to kind of also follow through on the work that was done before, meaning you saw something that you liked in maybe the previous couple days, and now when you come up to the list tomorrow or the next day after that, you're like, why did I put a check mark there? By the way, if I come back tomorrow and I see a whole bunch of these check marks at the top of the list on a percentage change, that tells me that the list that I kind of highlighted by putting a check mark there, that I could have been right. Other investors saw those set up and they pushed those stocks to the top. So nice. Okay, now let's go back to just real quick IBM. Finish that up, but there was a question on that. And I think that's one of the questions that kind of happens sometimes is, well, how do we find the stocks? Believe it or not, some people don't run searches. They actually literally go through the list, okay? They literally go through the list and they're manually looking at those charts. There is value in actually doing that because as good as, let's say, some of the scripting is, just seeing it yourself with your own trained eyes, technically, I like looking at the Market Watch quote page and looking at the charts. That way you're synchronizing yourself to the data statistically and also on the graph form, okay? Now what I'm going to do is, in closing here, I'm going to put the target right at about, what I'm going to do is I'm going to put it right about 537. I don't know if it's going to go there, okay? Put about 537, dated GTC. Remember, its earnings are next week. You always want to check the company's website, okay, to check on investor relations. to say confirm, is that when the company is going to announce the earnings on their website. And if I take a look at this, if I set a stop underneath, let's say 514 less 2%, 503. Now, clearly on this is I'm giving it some room on purpose. I want to have lesser chance to get stomped out and a greater chance to potentially go to the target, okay? And so now I know I have 100 shares, but I'm at time. But these are going to be the numbers that we're going to look at on Microsoft. So we did about 3 trade examples here today. Keep an eye on these companies of how they're actually doing on earnings. Don't forget that what we actually said regarding that maybe some investors might consider buying the group over individual stocks. I think that's a very important point to pull out here today. Now, remember, if you have not subscribed to the Trader Talks channel, do so now. There is also a link in the chat for a survey. Just 2 questions. If you enjoyed today's session, fill it out. Second, if you could also do this as well, smash the thumbs up so that way other people could find this content as well. Stay tuned for our next webcast coming up right at the top of the hour. And thanks to Ben Watson as well for answering those questions in chat. This has been the session on trading growth and value stocks. Thank you so much. Take care. Bye-bye.